Hey everyone, welcome back. All right, today we are tearing right into Apple's massive FY2 Q26 earnings. And listen, this explainer is going to literally save you 2 solid hours of sitting through that actual call. We are distilling the 3 absolute key catalysts that are reshaping your US tech stock strategy right now, from the massive iPhone 17 supercycle all the way to their brand new AI roadmap. Here's our playbook for today. We're going to start with the earnings beat, dive straight into the iPhone 17 supercycle, unpack Apple's AI strategy, take a hard look at supply chain risks, and then finish up with what you really care about, shareholder returns. All right, section 1, the earnings beat, defying market expectations. Let's kick things off with this absolute jaw-dropper of a number, $111.2 billion. That is Apple's total revenue for the quarter. We're talking a massive 17% year-over-year growth. Look, for a company of Apple's sheer size, moving the needle 17% is incredibly difficult. They didn't just meet the street's expectations, they completely blew past their own guidance. Earnings per share jumped 22% to $2.01, and net income hit a staggering $29.6 billion. And get this, they did all of that despite some seriously looming supply constraints. So where exactly did that $11.1 billion actually come from? Well, no surprise, the iPhone remains the undisputed king, bringing in $57 billion. But you really need to look at services. It pulled in a record-breaking $31 billion, growing 16% year over year. Services is the high-margin engine of this entire operation. Think about this. While their overall gross margin was a very healthy 49.3%, the services margin alone was a whopping 76.7%. It's brilliant. Apple is masterfully selling hardware just to lock users into these ultra-high-profit subscriptions. Moving right along to section 2, the iPhone 17 supercycle, the unstoppable hardware core. The iPhone 17 is officially Apple's strongest product cycle in history. I mean, we've all heard the endless chatter about smartphone stagnation and intense competition, right? Well, the iPhone 17 just completely shattered that narrative. They saw double-digit growth in the US, India, Japan, and Southeast Asia. But the real standout here? Greater China. It grew by an incredible 28% in the March quarter alone. It is literally the best-selling model in urban China right now, driven by a record number of upgraders. And when you pair that crazy global demand with a literal 99% customer satisfaction rate in the US, it's wild. People absolutely love the design, the durability, and how perfectly it integrates with Apple Intelligence. And this brings us to the ultimate result of that hardware dominance, 2.5 billion. That's Apple's current active device installed base, 2.5 billion devices globally. You guys, this isn't just some vanity metric they throw on a slide. This is the ultimate economic moat. Every single one of those devices is a direct funnel into that high-margin services ecosystem we just talked about, perfectly laying the foundation for their expanding enterprise tools and subscriptions. All right, pivoting to section 3, Apple's AI strategy, the agentic future. Apple made it crystal clear on this call. Apple Intelligence is not just some bolted-on gimmick to chase a trend. They are aggressively ramping up their R&D spend, actually growing it faster than the overall company, to treat AI as a fundamental core investment. Their strategy is deep integration across the iPhone, Mac, iPad, and AirPods. They're essentially transforming these devices into environments for Agentic AI, AI that actually takes complex actions for you. We're going to see a highly personalized Siri upgrade rolling out this year, and they've already teased that WWDC 2026 is going to reveal some massive leaps in AI software and developer tools. The foundational difference in Apple's approach, though, really boils down to this combo: edge computing plus uncompromised privacy. By processing AI directly right there on your device via the neural engine, you get the immense power you need, but without sacrificing your personal data to the cloud. It's a huge selling point. And hey, quick pause. If you want to keep getting the absolute latest US stock insights and deep dive earnings analysis just like this to stay ahead of the market, hit that subscribe button right now. I update every single week. Let's keep it real and move into section 4, supply chain risks, the reality check. The brutal truth is, Apple actually left money on the table this quarter. Sure, the iPhone faced some minor limitations, but the real bottleneck right now is the Mac line. Demand for the new MacBook Neo is massively exceeding their expectations, especially in the education and enterprise sectors, but production is severely constrained. And it's super important to note why. This isn't a memory shortage, it's a shortage of advanced process system on a chip, or SoC components. Management expects these Mac constraints to drag on into the June quarter and said it's going to take several months to fully balance out. Then you've got the other side of the supply chain equation, costs.
While the SoC shortage limits their volume, rising memory costs are actively threatening their margins. In the March quarter, Apple somehow managed to absorb these rising memory prices by just utilizing their existing inventory. But they explicitly warned on the call that as we move into the June quarter, the impact of those higher memory costs is going to become significant, which will definitely put some pressure on their product gross margins.
During the Q&A portion, an analyst asked CEO Tim Cook what advice he gave to executive John Turnus, and Cook's response was incredibly telling. He said, "Focus on what is most valuable to the company and users. Build the best products in the world." This perfectly encapsulates how Apple's management navigates these short-term supply chain and cost pressures. They don't panic. They maintain this relentless long-term focus on the product itself, completely trusting that premium user experiences will ultimately drive pricing power and profitability, regardless of temporary component headwinds.
Finally, let's talk about your portfolio in Section 5, shareholder returns, the bottom line.
Boom, $100 billion. That is the massive, brand new stock buyback authorization the board just approved. And on top of that, they are hiking their quarterly dividend by 4% to 27 cents per share. Think about this. Just in the March quarter alone, they've returned $15 billion to shareholders through dividends and buybacks. Apple generates just an immense amount of cash. We're talking $28.7 billion in operating cash flow this quarter, and they are aggressively using it to reward their investors.
But wait, there was actually a massive strategic shift announced on this call that you need to know about. For years, Apple has targeted a strict net cash neutral position. While they just announced they are dropping that formal target entirely. Why? To vastly increase their financial flexibility. They've got $147 billion in cash and $85 billion in debt. By ditching that net cash neutral mandate, they are giving themselves the agility to heavily fund their massive expanding AI investments and R&D while still sustaining those gigantic long-term shareholder returns. They're prioritizing business investment for the Agentic AI era without turning off the buyback spigot.
So here is the ultimate question for you guys. When you weigh the short-term memory cost headwinds against the historic iPhone 17 supercycle and the huge potential of Apple Intelligence, is right now the time to add Apple to your portfolio, or are you waiting for a pullback? Let me know your specific strategies down in the comments. I'd love to read them. Thanks so much for joining me on this explainer, and I'll see you in the next one.